The second video on the purchase process is getting financing and the need for a pre-approval. In this episode, I'll be interviewing Ritter from Citibank to talk about what you're going to need to know. Buying a property in New York City is unlike any other purchase in North America, and getting a mortgage in New York City is also quite different. So we're meeting with Ritter from Citibank. Aaron's going to talk to us today about what you need to do to get a mortgage in New York City and what to look out for. So let's just assume that most of the people who are listening are first-time buyers in New York City. What would be the most important things you'd want to tell them?
I would say the most important thing from the beginning is to get pre-approved. So the second that they even think about looking to buy a place, they should go and get a pre-approval and start the pre-approval process, because there are many mistakes that people could avoid by starting early.
Yeah, as a real estate broker, I would concur that that's a really good suggestion. So what's the difference between a pre-approval and a pre-qualification?
So a pre-qualification letter is basically a qualification letter that just says, hey, we took an overview of what's going on with you. A pre-approval letter is we've gone deeper into it.
So in other words, a pre-qual really doesn't really mean anything. It says we think we can get you a loan, but we're not.
Correct.
We're not actually saying. So when looking to put in an offer in on a space, a good broker is going to see a pre-qual letter and say, forget it, I want a pre-approval letter.
Absolutely. They're going to want to see a pre-approval letter. They're going to want to see it, a recent pre-approval letter, one not from 6 months ago or a year ago, one from within the last 3 months, just to make sure the person's fully qualified, their credit has been pulled, their income is in place, and everything looks right.
And how long is that process from the first time they talk to you to actually getting the pre-approval letter? How long does that normally take? And I understand it can range.
Yeah, I would say it's around 48 hours to as much as a week and a half, depending on the loan size. So any loans above $1.5 million loan size takes a little bit longer to do for us.
And some buildings take a little longer too, yes?
Correct. Well, with the pre-approval process, we're not going to be looking at the building per se to start. We're just going to be looking at the person and looking to qualify them. Once the person says, hey, I'm looking at this specific building, then we'll look at the building and qualify the building as well.
Because some buildings not every bank will loan on. Correct. And it's important that if there are issues with certain buildings that we get them to the right bank or to the right lender.
Absolutely, yes.
Okay. And that's one of the things that they do at Citibank. They'll be able to tell you, yes, you're on our list of good buildings. You're not on a list of the buildings that we're comfortable with loaning.
Yeah, we have a database of thousands and thousands of buildings here in New York City, approved buildings and buildings that we've looked at and vetted to know whether they're approved already on our list and they're good to go for the client.
Now, one of the things that I've heard from people coming from other parts of the U.S. is that the pre-approval process in New York is much more stringent than the pre-approval process, say, in Des Moines, Iowa. Is that your knowledge?
I would say so. In Des Moines, Iowa, you're getting a lot of people that are just W-2 employees. Here in New York, we seem to have a lot more complex situations, a lot more complex issues that come up for clients.
In terms of how their income is, yes, because when you sell corn, there's just so many ways you can sell corn. So
correct.
That's me being demeaning right now. Sorry, Iowa. So okay, so pre-approval is the most thing. So let's talk about what amount of financing you can generally get on different size of loans and also on different loan products. So obviously. Well, not obviously, but we're going to talk about how you generally have to put more money down on a co-op than you do on a condominium, and a townhouse can really vary. So what are your thoughts?
Yeah, so if you're looking at a co-op here in New York City, basically you're looking at a minimum of 20% down. Some co-ops want to see 25% down, some co-ops want to see 50% down. So depending on the building and the building's qualifications, they're going to want to see between 50, 20, or 25% down.
There's even a few 70 and 75% down buildings.
Correct.
On Park Avenue.
Yeah. So overall, though, most buildings are 20% down. So if you come across a building and it's good to know how much you need to put down. And I would say that's part of the pre-approval process is really getting pre-approved from the beginning, knowing how much you're able to afford and put down, so that when they come to you, Patrick, they know, hey, listen, I'm buying $1 million property, I have $200,000 in the bank, plus I have reserves. They know their numbers and they know they're ready to go.
Now, I know that sounds daunting to many people, putting 25% down because it's not happening in the rest of the country. Let me tell you what the huge benefit is to that. So when the market fell the last time, when they had 100% financing in California and 95% financing and 105% financing, when the market turned and values went down, the market went bust because nobody had any equity. But when the market turns in New York, and you have that 20% equity in each home at least, then there's not the same reaction. So we don't see the same downturn in New York because there's more money down. And that's one of the many reasons why New York real estate is a much better investment than the rest of the country, in my opinion, for that they don't allow 100% financing or even 95% financing.
Yeah, absolutely.
Now, you can get 90% financing on a condo in New York, but you don't always, because you have to pay something called PMI.
Correct.
And what's PMI?
So it's private mortgage insurance, and basically you have any loans up to $625,000 that you're going to be doing over 80% financing to 90% financing. There's PMI, which is private mortgage insurance, and basically it's an extra amount that you have to pay on a monthly basis to get that loan. So basically you're paying a third party to insure it on a monthly basis. But the challenge here...
And what are those rates running today? I know that varies, but what
the interest rates are going to be the same as a regular mortgage, but it's around 1% over the life of, over the mortgage, over the year that you're going to have to pay for PMI.
Okay.
90% financing would be $625,500 loan size.
Oh, that's all?
Yeah. Now, we do have a product which is 85% financing up to $1 million. So and that product with Citibank is no PMI actually. So it's a nice product, but you can go to 85% financing. And this would only work on a condo in New York. It's not going to work on a co-op a lot of times because the co-ops don't allow 85% financing. So
and then what happens if the loan amount had actually been over $1 million? Would it be structured two ways, or do you just have to go with the over $1 million? You have to put 20% down.
Got to put 20% down for us.
On anything on condo. How about on a townhouse? Because I find that really ranges dramatically from what one bank will loan to another bank.
Yeah, for us it's basically 80% financing above 625 for townhouses and condos.
Oh, so not that we ever have a townhouse under 625,
yeah, exactly.
We don't. But if we did, you could actually get 90% financing?
Yeah, up to 625 loan size, correct.
Well, trust me, that's a theoretical, Dorothy, I'm
Queens,
not in Kansas.
In Queens.
Yeah,
maybe.
But it'd have to be way out, even in Queens, it's way out in Queens.
Yes.
Way out in Queens. All right. So talk to me about Freddie Mac loans versus what we have in New York, because generally we don't even have to deal with Freddie Mac requirements because our loan amounts are all too high. Is that accurate?
Yeah, it's accurate. I mean,
for the most part.
So for the most part, any loans up to 625, 500, we sell to Fannie Mae and Freddie Mac. Okay, so those are the two large, mortgage companies that we'll sell our loans to. Above 625, we keep the loans on our portfolio. So Citibank has a portfolio of loans. So basically any loan above 625 up to $8 million of loan sizes, we're keeping it on our portfolio and we can lend in-house. Above the $8 million, we could do as an exception.
We get the pre-approval that helps us to get their offer accepted with the listing broker. We sign a contract. Now what's the next step?
Then basically the mortgage process begins on our side. So what we're going to do is order the appraisal, okay? We're going to request all the documents that we didn't request prior, maybe W-2s, current pay stubs, current asset statements. Maybe we have asset statements from 2 months ago that we started the process. Current asset statements to show enough money for the down payment and for reserve purposes. And we'll just make sure that all the credit is up to date. And we take that, order the appraisal. Once we get the appraisal back, we send it to an underwriter. An underwriter basically is someone that's going to review the file, make sure that the loan fits our guidelines, fits either Fannie Mae, Freddie Mac, or the bank's guidelines if it's above 625. And then we're going to issue a commitment letter. And that commitment letter is very important, especially here in New York, because you have a lot of times certain amount of days in order to get that commitment letter. It could be a 30-day time period to get a commitment letter. So once we issue that, a client's going to feel confident knowing that, hey, I'm going to be able to buy this place and there's no issues that come up.
So in general, let's say we had a really prepared buyer where they had already put together their loan application package before they signed their contract. They sign the contract, or maybe during the week while they're doing their due diligence, they put it together so that when they sign the contract, the next day they submit their loan application. From the day they submit their loan application to the day we actually get a conditional approval, how long in general, and again, it's going to range in New York, but how long in general is that going to take?
7 days.
Oh, it always takes longer than that.
7 to 10 days.
It always takes longer than that. I find that's usually like 3 weeks.
Yeah, well, I like to, if a client is advanced in terms of we have all the information already, it's going to be 7 to 10 days. If we have to start gathering the information at that point, you're talking 3 weeks.
Okay, so maybe that's what happens most of the time.
Most of the time, clients are a little slow with.
Okay, and sometimes the appraisers get really backed up because there's a lot of transactions going on, and that
Sure.
can slow down the process too.
Yeah, appraisal turn times typically also around 7 to 10 days, but it depends on how complex the property is. If you have a property that's a 100-year-old property and it's just a funky, different property that you find, it's going to take them longer to appraise that property because now they have to do a lot more work versus a typical condo or co-op in a specific building.
Okay.
So it's depends how long the appraisal is going to take. Typically it's 7 to 10 days, but it could be as long as 3 weeks for an appraisal.
Makes sense. Anything else our viewers should know?
Well, I always like to talk about the 4 things that the bank looks for. So basically, the bank looks at your income. They're going to look at your debt to income ratio. So basically, your debt to income ratio is how much debt you have to how much income you make. So an example is a client that makes $100,000 a year. We want to see their debt to income ratio at 43%. So we take $100,000, multiply it by 0.43, and we get $43,000 a year that a client could spend on a home, all their debts on their credit report, insurance, taxes. Comes out to be around $3,500 a month that a client could spend on a property if they make $100,000 a year.
And they're pretty much debt-free in other areas.
Correct. So $3,500 a month, and they can buy a property. What's that going to get them? That's a separate question. So we look at, first thing is your debt to income ratio. The second thing that the bank looks at is your credit score. Do you have a 600 credit score? Do you have an 800 credit score? So basically, credit scores go from around 550 to 850. And we want to see a credit score typically above 700 is what we're looking for when we're getting an application.
Which is also a good point when if you have investment property and you're going to rent out an apartment that you own, it's good to get their credit score and see, obviously a number above 700 is a little bit
Sure.
better than somebody in the 660 range.
Correct. So we look at the credit report just to get a sense of where things are. And we see a lot of people obviously above 700 credit score. So it comes up very often where it's a low credit score, but usually clients are on top of their credit score and looking at their credit score, and that's one of the advantages of a pre-approval is that we're starting
Right.
ahead of time, knowing what your credit score is and doing all the work ahead of time. The next thing the bank looks at is your assets. Okay, so if it's 20% down, which is required here in most places in New York, you're going to have to put down, let's call it $1 million purchase price. So you'd have to put down 20%. So you need $200,000 ready to go of cash, ready to go. And then the other thing the bank looks for.
And then how much are they going to want extra assets in addition to
Correct.
the 200 down?
Yeah, we're going to want to see reserves. And the reserves are going to be between 9 and 12 months of the monthly payment. So if the monthly payment is $3,500 a month, we're going to want to see 9 and 12 months of that.
Oh, I didn't know
payment.
that. That's good to know. That's a good
Yeah.
formula.
So that's basically what we look for on the asset side. So it's the down payment plus reserves. And then the last thing the bank looks at is the property type.
And do the reserves have to be cash or liquid, or can the reserves be in semi-liquid or less than liquid things like fully owned properties owned?
So it's a great question. So there's so many kind of aspects of what's included in that. So basically, if it's a property, we're not going to count that as assets.
Okay.
But if it's a 401k
Okay.
or a retirement fund, we will look at that as assets, and we
Okay.
will give that credit, not at 100% dollar for dollar, but 60 to 70% of what the value is. Because if you do have to liquidate it, we want to know that.
So in other words, if you owned a second home upstate that you own free and clear, because it may take a long time to sell that
Correct.
property,
We don't count that
you're
at
not
all.
going to look that as into your formula.
Exactly. We're going to look at it as a liability versus an
Oh, really?
an asset.
Oh, that's interesting.
Yeah, because we're going to use the monthly debts in the debt.
Oh, because your
increment.
taxes,
Correct.
on. Okay, and then there's
The
one
last
more
thing,
element.
The last thing is the property. When you look at a condo or a co-op or a townhouse here in New York, we can lend 80%, 85% loan to value, 90% loan to value at some points. So we're going to look at that property and we're going to do the appraisal. So that's the fourth thing the bank looks at is the appraisal and the property and what type of property is it. We're going to compare co-ops to co-ops, condos to condos, homes to homes, and that's what we look for. It's the fourth thing that the bank looks for is when they're approving someone for a loan.
Great. So let me ask you the most important question. Are you related to John Ritter? You look
I
a little
actually
like
have
him.
a cousin, John Ritter, but I'm not related to the
You
John
look
Ritter.
a little bit like him. You could be like the long lost black sheep of
Little
the
Jack
family.
Tripper action?
Yeah, little Jack Tripper. Around,
Knock on my door.
Come knock on my. You're dating yourself if you say
I
that,
know,
so.
I know.
Thanks, Aram.
My pleasure.
Okay.